Welcome to Bangalore School of Banking. This is Satchidanand Rath here. It's my immense pleasure to put the first video on banking awareness, which happens to be the most important part of any banking exam, may it be provisional officers exam, management trainees exam, or specialist officers exam. This particular section is a vital part of the written exam and the major part of the interview. But this remains confined only to students who have got finance as part of the studies in their graduation, or those who have done MBA in finance. To the rest of the students, it remains in dark. I believe you will enjoy this section like quantitative and reasoning, and will find the discussions as easier and as interesting as the quantitative and reasoning discussions. Like always, before going to the discussions, let me make certain things clear about Bangalore School of Banking. I'm intimating you people once again that Bangalore School of Banking doesn't have any franchises. No person is appointed to do any form of DVD transaction. The complete pack includes banking awareness videos, English and current affairs monthly updates given free of cost. These are my savings account numbers. Please avoid these two accounts because these are savings accounts and I'll be charged around 200 rupees on 3000 rupees, whereas this is a savings account of State Bank of India where I'm charged only 25 to 30 rupees. But if you're going with Bangalore School of Banking, this is a current account and I'm not charged any amount for any number of transactions. You can also transfer by PayPal if you're comfortable enough by logging into the website. Many times students ask me this particular question: how many DVDs? Whereas the better question is how much of data is there in one DVD? Because the video that I'm projecting now could be around 1 GB, but while you're downloading, you'll find that it's only 80 or 100 MB. Requires some knowledge of video conversions. In fact, your donations from ₹100 are most welcome, so that I'll be able to put more videos free in the YouTube. Complete discussions of banking is ₹1000. Courier charge of ₹150 is in fact extra, whereas banking videos are given free in the complete pack of ₹3000. Whole credit of my project goes to great Australian physicist of the 1960s, late Julius Sumner. I'm always grateful to Mr. Sergey Brin, proprietor Google. Let's go with the most frequently used terminologies in the banking industry. One is the CRR, one is SLR, one is PR, one is RR, one is RRR, one is CAR. So CRR is cash reserve ratio, SLR is statutory liquidity ratio, BR is bank rate, RR is repo rate, RRR is reverse repo rate, CAR is capital adequacy ratio. So as on today, that's 23rd Jan 2012, CRR stands at 6%, SLR 24%, BR 6%, RR 8.5%, RRR at 7.5%. CAR is capital adequacy ratio, which actually varies from bank to bank from time to time. Well, this is the information that you people can get from newspapers or from other sources. Let's bother why these terminologies are there in the banking industry. Let's analyze what's the use of CRR as such. Now, if I will open a bank and I have got ₹100 with me, I've got 100 rupees in my pocket, and let me say I want to open a bank. So what I'll do is I'll have to first go to Reserve Bank of India and I'll have to give ₹6. That RBI asks ₹6 from every ₹100 to give to it. This is called CRR. Then I'm left with 94 rupees. 100 minus 6 is 94. From this 94, again I have to give ₹24 to RBI, and this is SLR. So how much money I'm left with now is 94 minus 24, which is ₹70. So totally, as CRR and SLR, I gave ₹30. So why should I give 6 rupees to RBI and again 24 rupees to RBI? These all terms actually explain why the Indian banking industry is the strongest in the world. Now, RBI asks or forces the banks to give 6 rupees from the 100 rupees. Let me just come to the bank as such a little bit. Now, a bank is a financial organization, a financial institution that starts without any investment. If I wanna start a bank, I do not require 1 rupee in my pocket. What I do is I just get ₹100 from some people, and this 100 rupee I divert to other people. So you can say I'm borrowing from some group of people and I'm lending to some other people. Okay, fine. Now this ₹100 is not my money, it's the money of people, what we can say, public. Now if tomorrow something wrong happens with me, something goes wrong to my business or something, that I took ₹100 from people and I diverted ₹100 to others. I borrowed and I lent, and these people didn't give me in return. They didn't return. Then this ₹100 that these people have given, they are likely to ask me the amount back. So when I'm using this ₹100, I should always be there in a position that whenever somebody is asking this ₹100, this money, I have to give back. So thereby RBI, first of all, from this 100, he asks it asks rupees 6 as security, that if something wrong happens to the bank tomorrow, then at least 6 rupees is there to RBI, that is never lost permanently by any bank. So this is the hard cash, or money you can say, that any bank has to keep with the RBI. So it's basically to make our money secured. One is its security, and secondly, actually it arrests the freedom of the banks to give loans. That banks may not give this rupees 100 as loan. Full rupees 100 a bank can't give. One is security, so now the bank is left with rupees 94. Maybe from this rupees 94 he can give loan to people. So what happened is, there are some people here, there's a bank here, there are some people here. These are the people who are depositing money, and these are the people who are taking loan from the bank. So these people gave rupees 100. From this, rupees 6 went to RBI. Now this bank is left with rupees 94. These people are waiting on the other side. Okay, so the first part is security. It's definitely a very good reason. Now, why RBI actually arrests the freedom of the banks to give loans? Why RBI doesn't want that this bank will give loan? This is something called as inflation, that RBI controls something called inflation. Now let's bother inflation a little bit. So for example, there are some 10 families in a place, and each family is having 5 members. Fine. 2 parents and 3 children, let's say. And there is a tea stall here. There's a person who is selling tea. Now, on these 5 members, only two members are actually working. Let's say father and mother both are working. And that way, there are 10 families, so there are 50 people, and so on. Now, something happened that on these 3 children, 2 children got jobs. So when they got jobs, they got money. Now, over here, let me say 20 people were taking tea, and this person, the tea stall owner, is actually ready with some tea for these 20 people. Now next day he's finding that there are extra 20 people. Let me say, if some people are getting, 2 children are getting jobs from, let me say, each family, so some extra people, let me say 20 or some 15 people, they are standing for the tea. So what he's finding is, he's not having so much of tea, and he himself can't make so much of tea so fast within a particular time. So what he will do is, he will think that there is a good business here, as people are taking tea and they are actually requiring more of tea, or tea demand is more. Demand of tea is more in this place right now. So he will go and he'll hire some more people. He will get more of tea leaves or whatever articles he requires, and thereby, as there is a high demand of tea, if he was selling at rupees 3, now he knows that if he is selling at rupees 4 also, tea will be sold because there are people in the queue. There were 20 people, regular people. Now there are today 35 or 40 people, and all are waiting for the tea. Now he can go with a higher price, because at the end of the day what he requires is profit. As a businessman, he requires profit. So when he's finding that there is a high demand, then he will increase the price to rupees 4. So whenever there is an increase of price, that is called inflation. It's not a daily price increase, like today rupees 3 is there, let me say tea, tomorrow is rupees 4, tomorrow is next day it's rupees 2. It's not like that, it's taken annually. Now if the price of the tea is falling due to some reasons, if it is rupees 2, then that is called deflation. DEFLATION. And if it is remaining almost unchanged, then this is called stagflation. Okay, inflation is not a bad term. If there is inflation, it's not wrong or bad. But if there is high inflation, then it is bad. And when there is a high inflation in a country, let me say there is a serious inflation tomorrow, and for 1 year in India, then in India rupees won't work. It may be dollars or pounds that we'll have to use. So if I'll bother inflation as such, then I will say that inflation occurs when people become rich, when they have money. Money in financial language is called liquidity. Now let me say I had some gold in my house, and I went to a bank, and the bank gave me some money. So I can say that gold is easily transferable to money, so gold is having high liquidity. And when I have, let me say, 4,000 in my hand, I can say I have 4,000 liquidity. I'm bothering the terms in a very basic way. So what I do is, to become rich, one thing is I'll have to get a job, or second, if I'm getting a loan. So if the person is getting a job, he can go to the tea stall. Tea is just an example. I can say like he can go to buy a car. If he's not getting a job but he's getting a loan, then also he's going to take tea, and thereby the inflation occurs. So what RBI does is it tries to control inflation, but it's not so much it can control, because CRR is just rupees 6 on rupees 100. Now let's come to the term SLR. This is statutory liquidity ratio. Statutory means legal, that RBI forces the banks to give rupees 24 more. Liquidity basically means it can be cash or anything which can be converted to cash. Like as I told, it can be gold. Like apart from getting rupees 100 from people, some people have actually given me some gold that I can give to RBI. The basic difference between CRR and SLR is this rupees 6 RBI will never return, will never give to the bank. Whereas this rupees 24 it can give back as loan. Let me say when bank is requiring some money, he will go to the RBI, the bank will go to the RBI and will ask, give me some loan, then RBI will give loan from this rupees 24. But this rupees 6 RBI will never give, and ultimately when the bank closes, when the bank shuts down, then RBI will return this amount. That's called bankruptcy. When the bank goes bankrupt, then RBI gives this rupees 6. But as long as the bank is running, this rupees 6 RBI will never give. Statutory liquidity ratio. Again, this liquidity meaning money that if the bank is giving to public, like there are 100 people here, there's a bank here as I discussed, there are 100 people here. So now if RBI is not taking this rupees 24, then the bank will give money from this 24 also. What I'm saying is this 100, now it's 70 rupees left because 6 rupees gone, a CRR 24 gone as SLR, so 30 rupees are gone. Now the bank is having only 70 rupees to give to these people who are standing for loan. So why RBI arrests this 24 particularly is again inflation, that it controls people becoming rich. But it doesn't arrest it. It doesn't arrest. Here there is 70 rupees for the banks to give to the people. So the inflation should occur and it should be quite controlled. Because when the inflation is there, I mean the price is increasing, this means people are getting rich, this means people are getting job, this means people are getting educated, this means the country is improving. All this we say in one terminology, economics. So inflation is the measure of the economical strength of a country. On the CRR and SLR, RBI does not pay any interest to the bank. It just gives the money with it. So 6 plus 24 is rupees 30. Now the bank is left with rupees 70. So if the bank is having 70 rupees, and a person is asking some loan of, let me say, 20 rupees. So 70 minus 20 is something rupees 50. According to the RBI guidelines, if the bank is giving rupees 20 as loan, it must have that much minimum. That the bank is given 20, it's 50, that's fine. Now let me see. The person asks rupees 30. So 70, he asked 30. Now the bank is left with 40. He can give the loan. Bank had 70. If the person asks rupees 40, how much the bank is left now? Is 30. What he has given that the bank is not having, bank can't give the loan in this case. Not only the rupees 20, it's actually, if the person is taking in 2012 rupees 20, then in 2017 the 20 he has to return plus some interest of, let me say, rupees 5. He has to return. So this is rupees 25. Now this is 70 is what the bank is having, divided by this, the amount that the person will return after 5 years. That is called as risk in management terms. So this is 25. This is the amount that the bank is having. This is what the bank has taken as a risk, because first of all, this is the 20 that the bank has taken risk. The bank doesn't know whether the person will return or not. Not only that, the rupees 5 with the interest, with the only income of the bank. Bank's income is interest, so it loses the main money, so also the income. This is a ratio which can never be 70 by 40 because of this. So we can say this is total capital divided by total risk. Total risk basically meaning this 20 and this 5. Now this total capital by total risk is called CAR, capital adequacy ratio. So you can make out this is a figure which can be like this, but which can never be 40. This has to be greater than or equal to 2. If bothered in percentage, should be greater than or equal to 200%. The CRR is a part of something called as credit risk management, and is the vital part of something called as Basel II. Basel is a place of Switzerland, and the principle that the CAR that is followed in India makes the Indian banking industry the strongest in the world, and this is one of the major reasons that the Lehman Brothers of United States, the biggest bank of the world collapsed. And this is one of the main reasons that the bank didn't maintain CAR. It didn't bother how much money it has given, and after that how much money is there in the bank. Basel II is the agreement or the meeting that many banks attended, that collaboration of the banking discussions, what is called as banking principles. Basel II is the second meeting which was held in 2004. Previously in 1984, there was a big recession and all the banks of the world met in a place called as Basel. It's a city like Bangalore, and whatever guidelines, principles RBI is following, RBI says it's modified Basel II, because as such no country can directly implement Basel II concepts. Please join me in the next discussion where I'll be going with bank rate, repo rate and reverse repo rate. Thanks for watching.